So last week Fed July FOMC minutes. Let's see what this PDF say about future monetary policy decision. So first thing, spot forward measure of inflation based on treasury inflation protected security. These are tips and your 10-year bond yield. This is biggest enemy of gold right now. So more inflation goes down, more 10-year bond yield go up, more tips will go up. So until this thing does not turn, gold will not turn. Then next, significant probability of recession occurring by end of 2024. This line is most political. You will have election in next year and they are forecasting recession in end of 2024. Indirectly they are saying there will be voting in recession, and if that happen, current president will lost election and next person, if Biden repeat or new person come as a president, he will be luckiest person, because all he have to do just ask Fed to do easy monetary policy and stop recession. Don't think Biden will allow this thing. They want recovery monetary policy just before voting next year. So be careful about this thing. Timing of recession expected by survey was again pushed later. So this drama is happening since beginning of the year, your 500k NFP. So economic data are pushing recession later, but they cannot do it forever. So FOMC is saying avoiding a recession through 2024. And most important line in this PDF, expectation that July rate hike would be last of this tightening cycle. They are saying this can be your last rate hike, July FOMC meeting. That means complete end of your rate hike. This is FOMC member are saying. This line was dovish, but they balanced everything. So they added some hawkish line. Addition monetary policy tightening after July FOMC meeting was possible. So they are saying after July more rate hike. This was the hawkish signal from FOMC minutes. But key line is July rate hike would be last of this tightening cycle. And this week you have Fed Jackson Hole speech. Let's see what he say about this thing. And expected real rate to increase through first half of 2024. In June FOMC he said about decreasing real yield, and New York Fed also said about decreasing real yield, your tips, but they are saying increasing through first half of 2024, then remain above their expectation for longer run. So it is not about rate hike, it is about tips, how long real yield stay positive. So tips will turn before your actual interest rate decision, like same like you saw in August 2020. Rate hike came 2 years later, but market turned in August 2020. And information available at the time of July FOMC meeting. What happened after that? You have seen loan survey data that was indicating recession, but that news was replaced by Fitch rating news. So everyone forget. And your CPI and NFP both came lower than expected number after July FOMC meeting. And this speech will be after these three numbers. So except Bowman, all FOMC member tone has changed. Let's see what Powell said this week after CPI and NFP. Manufacturing, increase in motor vehicle production. This is your Bidenomics because Biden want manufacturing in USA. It is not special about Biden. All politicians now want manufacturing in their country. But manufacturing time has gone. Future is service sector. So because of these Biden decision, economy is re-accelerating and risk for inflation, then ultimately more hike has increased. Then fading from China reopening. Since July FOMC meeting, China economic condition is changing. Now we have news like China economic collapse while they were talking about in July FOMC meeting. So what they say about China this week will be most important. And weakening activity in Canada, Mexico as well, weak external demand. So USA can go into soft landing, but except USA, all other countries are going into recession. So global consumer demand is slowing. Next is USA. And stock price for largest bank fully recovered. That's mean you can say Silicon Valley crisis is completely over. But who knows, same like China, Evergrande crisis is back after 2 years. If Silicon Valley crisis return again, then you should not say this is a new thing. Loan officer survey. So last data was predicting recession. Next one will also predict recession. Staff no longer judge the economy would enter a mild recession. So you should remember in July FOMC meeting, Fed officially said they no longer see recession. And they are saying increase in unemployment rate. So NFP number is one thing and unemployment rate is other thing. I cannot say about number, but rate will be 4% before this year completely end. So it is fixed right now around 3.5%. That 0.5% change will change entire market sentiment. But unemployment number are most lagging indicator. Then again, uncertainty about lag in effect of monetary policy. So after their 4 times 75 basis point rate hike, you saw Silicon Valley Bank run. It did not happen next day after their rate hike, but few months later. So this is your lag effect. And Fed officially say many times lag effect is 12 to 18 months. So 1 year has passed for their 75 basis point first rate hike. So in future lag effect will only increase. It is visible in NFP. It is down from 500k to 187k. So ongoing tightening in banking sector and in coming quarters. So these things will only increase and this data only come once in a quarter. And most participants continue to see significant upside risk to inflation. This was your hawkish line from this FOMC minutes. while they are saying last hike. So it is balance FOMC minutes. So you cannot say hawkish nor dovish, but important thing is they are talking directly about last hike. So upside risk to inflation and further tightening of monetary policy. So CPI came higher than last month and economic indicator are showing economic growth, USA retail sale, and Fed now GDP is now showing almost 6%. So these are the reason the investor now think they can tight monetary policy again, more hike. That's why 10-year bond yield is flying. So I repeat again, this is the most important line. July rate hike would be last of this tightening cycle. And if you read this September FOMC minutes that came last year, you don't need to read entire PDF, just read this line on page 9. Appropriate at some point to slow pace of policy rate increase. This information came in October last year, 2022. What happened after that? Their rate hike size decreased from 75 to 25, and they also skipped rate hike in June FOMC meeting. So same like last year, not immediately now, but next month, that's mean you can say September, 10-year bond yield direction must change. Because now they are saying about last hike, that means end of rate hike. And if it is true, then 10-year bond should go down. And since August 16 that FOMC minute, you have not seen big change in gold price, something like $50. Gold is sideways on intraday chart near 1900 level. And now you have only 3 FOMC meeting. In September FOMC meeting, there will be no hike, and market right now is expecting a small 25 basis point rate hike. So if Fed repeats same line, that means end of the hike, that market pricing for November hike must be priced out. At the same time, their rate pause timing until May 2024, that can also change.